Hello and welcome to another episode of the Technical Roundup podcast, brought to you by the FTX app. We've got a very special and different episode today. I mean, obviously every Technical Roundup is special and different, but on this occasion, instead of having just broad themes we talk about with guests, we have just a long list of crypto terms and crypto native language and terminology, jargon, whatever you want to call it, things that feature quite regularly in our vernacular, but we're all crazy crypto native. We spent all day on Twitter for like several years now. And I just felt like a lot of the terms and, terminology that we take for granted and use day to day isn't necessarily well defined. And I think this really became obvious to me when Web3 just suddenly went from never seeing it to being the only thing you see on Twitter. And I just felt like it snuck up on me. I don't know how you guys feel about that, but Web3 just became like this massive thing within the space of 3-4 months. And I was like, wait, no one's bothered to define these terms. What does it mean? And it just got me thinking that we use language very liberally and kind of get used to it in the crypto space. So why not get someone who's really smart and does all this stuff? And the two primitive people in the show, which is Don and myself, obviously, we're just going to throw terminology at the smart person and get them to define the terms for us. How does that sound?
Yeah, works for me.
Don, does that kind of relay your experience of, we just take crypto native language for granted, and then, if you're looking from the outside in, it's like we're speaking a different language sometimes. That's what I feel like anyway. Like, if you ever tried to explain crypto to a normal person, then you realize how abnormal you are,
I mean, I know the feeling, because sometimes you actually use terms without ever having looked them up. And then you realize, oh, this actually, it does mean what you think it does, but in a different way. Just because you kind of get used to it, you see it, and you don't immediately look it up.
Yes.
And then you see like the context in which it's used. And sometimes it's nice to actually know what exactly it means and how it's used.
We're going to try to do that. Our guest is very well equipped to do so. It's CMS Intern. I want to start by dispelling the FUD, which I do every time I speak to him, which is that you're no longer an intern, right? You're straight up. I don't know what the formal title of the role is. Is it like associate? I don't know how CMS structures stuff. But yeah, who are you?
Yeah, so true. No longer an intern. That's going on almost a year now. Yeah, we kind of have official titles at CMS, but not really. They're pretty relaxed with that. I think I'm technically investment portfolio manager.
Oh, look at that.
But something along, I don't think I've ever actually used that term before. I think they just used it for the contract. But yeah.
Don, you see, every time someone comes on Technical Roundup, they've had some sort of promotion or progression in their career. Like RV went from head of trading to co-PM. Now, CMS Intern, no longer an intern. This seems to be the place to get a leg up for your career, which is pretty cool.
Yeah.
When is it going to happen to us? We're the only missing ingredient.
I was about to say that, we've never gotten an upgrade yet.
It's fine. We'll get there. Look, I want to actually start with a bit of a curveball. And this might set some context, because basically for our audience, we've broken down the terms we want to ask into 3 broad categories. The first, which is kind of VC, probably the most obscure to most people who don't directly partake in that part of crypto. The second is blockchain fundamentals, for lack of a better term. And then the third one is blockchain use cases, right? All the stuff we're used to. So when it comes to the first one, before we get into the actual terminology, it's a bit of a curveball, right? So in terms of stuff that's pertinent at the moment and what the community is discussing, you can't get away from how poorly a lot of Solana ecosystem tokens are performing, right? At a certain point, you could just be, especially at listing for some generally short period of time, your Oxys, your Rays, your Serums, your maps, whatever they may be, all these Solana ecosystem tokens, they got listed, they did really well for a very short period of time, and then since then, the charts look irreparable, just like this infinite slow bleed, and now the community, upon reviewing, or kind of looking at these poor performing sectors, it seems like a lot of fingers are being pointed at the tokenomics, and the way that the money was raised for those projects in the first place. So do you just have an angle, or how you're thinking about that specific sector doing so poorly? Is it even fair to look at the VC terms and say, this is an obvious problem?
Yeah, I can't comment too heavily on that, I would say. I definitely think that the Solana ecosystem, when it was being built out, we haven't really seen an L2 or an L1 ecosystem be built out kind of from scratch to being so quickly a multi-billion-dollar asset, or now I think it's like $70 billion. So it happened very fast, and there's a lot of experimenting that goes along with that, right? Oxy, Radium, kind of some of the early Solana projects had a lot of experimental tokenomics going on at first. So, I mean, I think that was the main thing that the team was thinking. There is definitely a somewhat of a misconception kind of in the public thought sphere around like, let's launch a tiny supply of the token and create like this extreme fully diluted value so like insiders can dump on retail. I think that was never the intention of the projects. I think that those kind of the differences between market cap and fully diluted value have I think that the kind of tokenomics there that created that gap and disparity were more kind of the experiments that came about with just being early projects in an emerging ecosystem. I mean, you can now go look at some of the newer projects coming out. A lot of them don't have that or have some variation. And a lot of the emission that comes about is also kind of paid out to people who are staking the coins, right? So if say, for example, 10% of a supply is out there in the market, and the rest, the 90%, is going to be emitted over the next like 7 or 8 years. If you stake your coins, then you don't actually lose, like as price goes down, you actually get more coins. So I think they're all just experiments within tokenomics. It's something that a lot of teams are putting a ton of resources into right now. Delphi Labs has actually been kind of on the forefront of this, trying to figure out what the correct tokenomics are for new coins and new projects. But I think it's just a byproduct of the amount of funding, the amount of growth that we've seen in crypto that's been happening so quickly kind of over the last 18 months now.
Yeah, and Don, it only becomes a real issue once these things start going down, right? Everyone's like, wait, maybe we should look at this. What are the drivers here? Once all that supply and all those emissions are unable to be absorbed easily, right?
Mm-hmm. I mean, we had this kind of meme going on, which was fully diluted valuation doesn't really matter on Twitter for a while. And that was just, in a bull market, it doesn't really, right? But when the market starts going sideways or even down, then people start realizing there's a bunch of coins that can still get unlocked or that can still get dumped. And it's basically almost never ending. So people start paying close attention to it.
Yeah, for sure. Let's take a swing at some of these terms. I mean, if we go to the very top of at least what we've got, and this will all be available, I'm sure, in the description or elsewhere. The first one we've got is seed round. And, for a lot of people, their exposure to crypto will quite simply be, onboarding via fiat to like some centralized exchange and then buying the coins and trading the coins available there. Maybe they'll punt futures and realize it's a bad idea pretty quickly. But, on the whole venture side of thing, which most people, at least outside of crazy ICO season and some of the modern variants, which we'll talk about as well, they're not necessarily partaking in these. So like, what is a seed round? What role do they play in the ecosystem? Is it as simple as just fundraising? Let's start with the basics.
Yeah, so a seed round is basically when a crypto startup has an idea, they're building out their product. Usually they're pre-product at this point. So they have their idea, they've tested the market to make sure that it's something that people will want. And then they go to raise money, usually from angel investors or VCs in the space. So at this, you're typically looking at somewhere between like a project valuation of like $10 million to like $60 million. And they're looking to raise like 5 to 10% of their project at that valuation. So kind of to sum it up, early stage projects that want to get kind of a kickstart in the space, just raising money from funds that do that in the space.
Yeah, I think most people are fairly familiar with that. Where where you have to kind of look more carefully is vesting, for example, right? All the stuff like the next three on the list, like vesting, cliff, unlocks, etc. Let's just start with vesting. I've seen that term misused a ton, and it usually comes up in the conversation of, okay, well, you have all these tokens and whatever the allocations may be to the team, etc. what kind of access do they have to those tokens, and people are trying to get a sense of, what kind of supply may be hitting the open market. I don't know if you want to do vesting, cliff, and unlocks together, or go one by one, whatever. But when we come to accessing whatever tokens you get as a result of the seed round, what do some of these terms mean? You can lead with vesting if you'd like.
Yeah. So vesting is basically the overarching term for how the tokens will get distributed, what the timeline looks like for token distribution. So usually that comes in two parts, the cliff and the unlocks. A cliff is basically a period after the TGE, the token generation event, where you wait to get your tokens. So if a project has a 3-month cliff, that means once the token goes live, there's no token distribution. And then 3 months after that, the tokens start being distributed. And then unlocks are basically just the day, usually like monthly or quarterly or something, where tokens get paid out to the investors. So usually you have, say a 3 or 6 month cliff. So the token goes live. There's usually no unlocks there. And then either every day, every month, every quarter, you get a certain percentage of the tokens, usually for somewhere between like 1 year to as long as 7 years.
Actually, it's as soon as I buy the token that all the supply hits at once. That's my experience.
Something that we used to have in cryptos, whenever like we got token unlocks or something of the sort, price went down because they started getting dumped. Nowadays, it's a little bit different. Do you know like the difference between or what happens when you have unlocks? Like, because we've had like bullish and bearish unlocks. Do you know why that is?
Yeah, so the bullish unlocks was a meme for a little while. Usually when that happens, and the reason it's a meme is because it's funny, right? Like you would expect if all these investors are getting paid out their tokens, a few of them are going to go market sell the tokens, and then that's going to drive price down, right? So usually you would think unlocks equals price goes down that day or shortly after. A lot of the time, though, that kind of overlooks over-the-counter trading of the tokens. So, for example, like Solana was a classic bullish unlock where the market knew that all these investors were about to get a big chunk of Solana. So the market accounted for that. Price dipped down and it was low, assuming that the investors were just going to dump on everyone. People didn't want exposure to that. But what had actually happened was a lot of these Solana investors, one, they didn't want to sell in the first place. And then two, any that wanted to sell actually sold over the counter to a different fund that did want it. So the unlock technically happened, and none of the investors were selling the token, and everyone was like, I thought whales were going to sell on us. I guess it's not happening. So they all bought back in. So that would be a bullish unlock where people assume it's going to go down. It doesn't happen, and then price ramps up after.
Do you think that's generally the exception to the rule when it comes to unlocks, or is it entirely contingent on what the state of the market is? Because obviously that was well timed with broader market forces generally, where everything was pretty positive. So do you think bullish unlocks are generally exception to the rule, or how is the market responsible for determining that outside of just the terms of the deal?
Yeah, I would say probably the exception. I mean, every single situation is going to be different there. Sure. I would say usually an unlock wouldn't be. I mean, you can look at the Coinbase IPO, right? Like this isn't a crypto specific thing where people go and invest, and then once they get their shares, then they go and convert to cash, right? Like that's kind of how all private investment markets work across the world. So like Coinbase IPO, people were up in enormous amount on their initial investment. The stock went live, people pumped it up a ton. And then all the people who had their shares to dump just dump them because now that they were liquid, right? So, I mean, it happens often. It's kind of just a market force that you have to take into account now, especially crypto. Like there's a lot of private funding now coming into crypto. These terms are going to get more relevant and kind of happen more often in the space. But yeah, sorry, that's kind of a long-winded answer to the short question.
Yeah, but no, it makes total sense. Something that I've been hearing about a lot is actually like that the market for locked tokens and for everything that's locked basically has become much more sophisticated in the last few years. So we've seen that with Jewel lately, where there's just a big market for locked tokens. So even if they unlock, it's probably not going to be as big of an event, I think, and in a lot of cases, just because the people that want to sell have sold it, and even the people that have been trading them, they're not sitting on as much of a multiplicator, right? Like if you've been holding something from like the seed round to when you can sell it, you probably sit on like a large multiplicator. But if you've been selling that over the counter, like you said earlier, and then someone else bought it and they're sitting on like a 2x, it's much more, it's much less likely for them to just order dump it all, because it's much less of a difference, in my opinion,
sure.
anyway. How would you describe FDV, or fully diluted valuation? Is that like something?
Yeah, especially
you
because
look at?
most people are familiar with market cap, right? That's kind of the go-to when describing, a project's potential. Look, this is X market cap, whereas this other project is Y market cap, which is only a fraction of the first. Therefore, that's all its quote-unquote upside potential. That's become pretty popular, but FDV is new. At least thinking about it is new. So, how do you define those two, and what's the relationship? How do you think about these things?
Yeah, it's a good question. I would say, well, first, just kind of the definition, right? Market cap is the market price of the coin times the circulating supply, and FDV is the market price of the coin times the total supply. So usually you would think that those things are pretty close, right? Like for Bitcoin is kind of the standard. There's like 18 million or so out in the market, and there's only ever going to be 21 million Bitcoin. So the market cap and the FDV are pretty close, right? Like they're within kind of 15% of each other there. So something that happened like Solana ecosystem definitely got a lot of heat for that when they were experimenting, and they would have a very small portion of the coin actually out trading in the market. So you would get these super inflated FDVs, fully diluted valuations. I think it's become more relevant too with these play to earn games that have come out, kind of the projects in the space there. And almost by design, right? It has to. So like an early stage game, a lot of these games aren't launched, but they have their token trading just to kind of gauge market sentiment, fill up their treasury a bit, and invest in the future game. But say a game has 10% of the token out trading in the market, the FDV is going to be 10 times higher than their market cap there. But the reason that they do that is that they need in-game rewards. They need to be able to incentivize the community to do kind of specific actions there. So, say you're looking at a project and 60% of the total tokens are allocated to the next 5 years of in-game incentives. Then that means those tokens won't be on the market for the next 5 years. It will slowly be emitted into the market. So it's something that's become more relevant in the space, especially in kind of the GameFi sector.
Yeah, I really like that. That's a good framework for it. And yeah, I think I agree with you as well. As tokenomics change and the types of things we use tokens for change, paying attention to FDV and where is the rest of the supply and what it's designed for, being reserved for, definitely makes sense. On the raising front, I guess as the final sort of bit on that, a lot of there are a lot of stages to projects raising money. So we talked about the seed round, obviously, but recently we all heard about ICOs in 2017, 2018, whatever, but nowadays that seems to have multiplied into a number of other sort of public facing fundraising mechanisms, and they're not mutually exclusive from having like a seed round, right? You might have something very private, for private individuals, and then something a bit more public facing. So I am of course referring to I, and then whatever letter in the alphabet is left, and then O is the third one, right? So we have IDO, IEO, TO. I'm sure there are a bunch of others. What do these things do? Are they exclusive to, can you have them alongside a seed round? Who are they made for? What's this sort of public facing fundraising mechanism? And why are there so many of them?
Yeah, that's a very, very solid question. I think a lot of the different letters, right? An IDO is initial DEX offering, IEO, initial exchange offering, ITO, initial token offering, etc. I think the reason that there's so many of them is because people are still trying to experiment to see what is the best way to actually launch their token into the public market. So for example, like Mango Markets kind of led and had a new way of raising capital where they opened a pool for like 2 to 3 days, and they said, we're selling 5% of our tokens or whatever the number was. And if you want to invest, put your money in here. So they gave 3 days for the market to kind of figure out what the correct price for 5% of it was. So you get an implied market cap from that. And then that was kind of how they launched their token, right? They found fair market price. Everyone kind of got in at the same initial price. And then you let the token trade from there. So the letters are basically different experiments or different ways to let your token be publicly traded by the market. And again, right, like that's kind of the key thing that a lot of funds and research firms have been doing right now is trying to understand what these different tokenomics look like. Really the only way to figure out if one of your different ways of listing the token is good or not is just through experimenting. And again, like I said, Delphi Labs has a really good tokenomics research group working on right now. They actually just, I think 2 or 3 weeks ago, put out a report on their own way to basically launch your token into the public market. So it's just something that we're still figuring out, right? Like it's really important to be able to have venture money in the space, right? Like it incentivizes new people to try to create new projects that push innovation and let people experiment in crypto. But there's obviously good ways to do it and bad ways to do it where investors are overcompensated or undercompensated, and the public markets either get scammed or they get, super rich, and people are just trying to work out how to balance those two. So the different letters, all the experiments that you see, it's kind of people working on that problem right now. What is fair? How can we help everyone win, and let the best projects win out in the end?
Yeah, I think that's a really good way of looking at it. And as you mentioned earlier, even the traditional markets haven't really figured it out per se. If you look at Robinhood and Coinbase is a really good example. It's not like these things go live to the public and then become stable coins or maintain fair value or whatever. I saw Matt Levine post in one of his newsletters how IPOs sort of perform early on and then on a larger time horizon. The difference there is really something else. So I'm glad we do similar experiments in crypto, because there doesn't seem to be a right way of doing things. But moving away from the experimental to the fundamental, I guess this is the fun one. So we've got here, as I'm sure you can see on your list, proof of work and proof of stake. So the kind of, I guess if I had to speculate on what the normie zeitgeist is, or in many cases people's only exposure, it's that proof of work is the one that boils the oceans. It's very energy inefficient, and then it's the whatever quote you have of Bitcoin uses as much energy as X, where X is presented as this big unreasonable energy usage, or as something super reasonable, and therefore by implication Bitcoin is wasteful. And then they read about proof of stake, where it's also a governance consensus mechanism, whatever, but it's not as wasteful and doesn't boil as many oceans or hardware intensive. Or maybe if you're a gamer, you know it from the GPU market, whatever. I think that's the base level comparison or understanding that exists when it comes to proof of work and proof of stake. You don't even necessarily have to compare the two, but like, what are these things? What do these terms mean?
Yeah. And I do want to start off by saying, I could have just kind of Googled the definitions of all of these things and read them off and sounded like a robot.
Thank you for not doing so.
Yeah, I think it it's kind of much better to. I just kind of ripped them off the top of my head how I think about them, try to be a little bit more formal with it, but I know if I'm too formal, then everyone will hate the podcast, and if I'm too kind of hand wavy, then I'm gonna get absolutely shredded on Twitter. So try to find a middle ground. But yeah, for proof of work, kind of the short there, it's the mining algorithm that's made famous by Bitcoin, invented by Satoshi. In general, it's trades. It's very energy intensive. It tends to be slower, but it's safe and secure, and that's why people love it. Proof of stake is a newer mining algorithm that's basically like proof of work, but the validators are rewarded or create blocks in a proportion to how many tokens they have staked. So the thought process with proof of stake is that people who hold more of the governance token, so for example, like Algorand is classic, just pure proof of stake protocol. If you hold a bunch of Algorand, you're incentivized to keep the network safe and secure. Otherwise, you have a lot of personal loss there. So the more there are people who hold more tokens, have more skin in the game, they'll probably protect the network better. So that's what proof of stake is kind of hoping to do. So on paper, right, like it's supposed to be faster, safer, less energy intensive. But again, people kind of take that as a religious debate, so I won't step on too much there.
It does kind of sound Ponzi-like, right? I mean, when you say it like that, the more you have, the more you get. It always does sound a little bit Ponzi-like.
Why do you think proof of work coins have basically died outside of really niche new coins? But even then, I think the overwhelming majority now is proof, and that's why most of the non-Bitcoin mindshare is towards proof of stake, or even slightly new versions like whatever Solana uses. Not even going to try to attempt to define that. But do you really think, is it just the energy debate? Is it a natural, people are going to hate this, but is it the quote unquote natural, what's perceived to be technological progression from proof of work to proof of stake? Because the market seems to be very much in one mind about what mechanism to use, and it seems pretty one-sided outside of Bitcoin. Do you have any back of the napkin reasoning for that transition or preference?
Yeah, I mean, I think it's a dance between everything you just mentioned. So like one, I kind of think about the driving force as the technological innovation, right? Like proof of work is arguably, a lot of people would argue like one of the most important inventions that we've come up with within the last 100 years or X amount of years, name your favorite. So that like understanding how to have decentralized ledgers is super important. And then a lot of people think, this is the standard. You can't get better than this. Satoshi is a godlike AI. He obviously got it right. And I mean, Bitcoin is the most successful crypto, right? It's the first, it's the biggest, it's, the one that has the biggest community, XYZ. So people love proof of work for that reason. I think as you start to look at these different mining algorithms and way to secure the network, just over time, right? Like people got in the weeds, they played around with blockchain and how to make it better. And again, right, like these are kind of all experiments, but a lot of them have worked really well, right? Like Solana's that you mentioned, proof of history it's actually very similar to proof of work. But it's, instead of blocks being like 10 minutes about, they're like, I can't remember the metric, like a millisecond or like 700 milliseconds, something
Or
nuts
2
like
days
that.
from time to time, right?
Yeah, depending if the network is up or not. Yeah. So all these people have different ways, and I think that just the innovation, like you get a lot of smart people working on this problem of how do you keep decentralization, but then you actually want to use networks that are fast and secure. And are there better ways to do that? So I think people experiment with them. And then there's market forces, right? So proof of work obviously has huge market cap with Bitcoin and Ethereum right now. But there are kind of the success of each of those experiments depends on how the market weights them. So one of the thoughts for Solana, right? Like people get kind of mad at Solana, not to pick on Solana, but just because they have, it's pretty expensive to run a node, so they get upset that they think the mining or people securing the network won't be that decentralized. But at the same time, right, you go and actually use Solana as a user, and it's incredible. Like it happens right away. It's basically free. There's all these cool new projects coming out on it. So users go on and they're like, oh, this is great. So they go and, they're like, I like Solana. I tried using Ethereum. It took all my money and burned it. What is EIP 1559? And so they like Solana, and then they go and buy into that, and that helps the market cap out a lot. So I think it's a different, like, it's kind of a balance. It's a dance between what works well on paper, what works well in the market, what will people actually use. Ultimately, I do think that there's a place for all of these things, right? Like there's kind of a spectrum of decentralization that you need for different things, right? Like if it's your family's generational wealth, you probably want that as secure as possible. You probably want to keep that in Bitcoin. Larger assets that you keep, say like if the metaverse happens and you have a house and you really care about making sure that can't be seized, you probably keep that on Ethereum. If you're playing a video game and you want to make sure you're paid out your $15, laser sword, Solana is probably fine for that.
I don't know. That's not my
that's kind of
experience.
my take on
People's
it.
generational wealth is being stored on Bored Ape Yacht Club seed phrases, which they give away to anyone that asks kindly enough. So that's the real store of value. Sorry, I had to put that in there.
No, it's true. It's kind of it's how the market is weighting them. It's kind of the dance, right? Like you would, or at least I think that people will probably fall into that spectrum, but let's see where people actually want to keep it and what kind of wins out at the end.
I agree with you there that I think the more sophisticated as a market participant you get, the more important that distinction gets to you. So like storing wealth or storing like a large part of your portfolio in Bitcoin just makes sense. The smaller kind of your portfolio is, the more kind of returns you want to make, the multipliers you want to have, and then you just store them on board Yacht Ape Club thingies, and that's fine as well, right? Something you said is that running a Solana node is expensive. What exactly is a node, and how would you describe it?
Yeah. Well, so node in general, right? A node is a computer that runs a mining algorithm that's connected to the crypto network and secures the crypto network. So, for example, like you need, or you use different nodes for each network. So Bitcoin miners, that would be an example of a node. Solana has these RPC nodes, which they're a lot more expensive to run. So kind of not to dive too far into the difference in the nodes there, but kind of people that want to fix scaling in crypto, they have a couple different ways that they think it'll work. The two main ways, at least that the market thinks are the best so far, are basically sharding and proof of history, so Solana. And L2s as well. So sharding basically, if you need to do a bunch of computations, sharding breaks them up into like 100 different pieces, and you can just fragment them and kind of do them all in parallel and then connect them back at the end. And that basically works out. So that's what ETH2 is going to do. Near is kind of the classic one that's doing it right now, that people are excited about. So basically you take this large stream, you break it up into smaller bite-sized pieces, do them all at the same time and go from there. Solana is more kind of trying to be a brute force computation. So instead of breaking it up into bite-sized pieces, Solana does the whole thing and they try to do it super fast. So in order to do that, you need basically like supercomputers to be able to process all of these transactions and keep it fast. And if you can do it well, there's a lot of really good traits that come about. So you don't need to break up all of the chain and do them in parallel. You can have everything time synced very well. That would be like, so a lot of the reason gaming is on Solana is because all of the time sync would work out very well. If you're playing against people in different countries and you're on a different chain, like it just is a lot easier to do it all on one really smart, really fast chain. But in order to do that, like I said, you need the supercomputers, and those are pretty expensive. So I think like a typical one would be like $10,000 if you wanted to run a validator for Solana, which people don't like. That prices a lot of people out of the network. But again, it's kind of a necessary evil as of right now to make sure that you can keep this super fast chain and be able to kind of reap the rewards that come about from having one ledger that all of the validators are seeing at a time. So I kind of answered your node question there, kind of talked about why you need different ones for different chains, but
no, for sure. Is the implicit harm that people are seeing when you're priced out from running a node is that decentralization is harmed? You know, if there's like a 10K entry point, then it's going to be incumbents on the network and bigger and fewer players who can afford to run them. Is that sort of how the argument flows?
Yeah, exactly.
Okay, cool. We mentioned scaling. I'm jumping a little bit, but we did mention scaling, and this is what happens. Like every time crypto gets hot, people try to use crypto, and it doesn't work, or at the very least, it becomes very expensive. And people who get like a bit of ETH sent to them to like ape into an NFT can't do it because the gas is too high, etc. And we always have some version of the scaling debate. It feels like going on in crypto. I know you feel very strongly about this as well, Don. So I'm sure you've got something to say. But in short, when we talk about scaling and different solutions, what does that term mean? What are we trying to fix or balance or achieve?
Yeah, so scaling is basically increasing the amount of transactions per second that you can get on the blockchain. I mean, that like full stop, that's scaling. And the goal is to do it in a way that is cheap and fast and effective so that everyone can actually use this stuff. SBF is kind of famous for saying we're not even close to being where we need to be. Like the best thing we have right now is Solana, and they're at 50,000 transactions per second, and we need millions if we want crypto to kind of turn into this thing that we think it can be. So yeah, that's scaling. The big debate: what's the best way to do it? How does it look in the future? But that's kind of the overarching way people in crypto are looking at scaling.
One way that scaling is discussed is by taking layer 1 stuff onto layer 2. Do you want to describe those points and then describe how that would help?
Yeah, so layer 2 is kind of how Ethereum has been scaling right now. As they get closer, hopefully, to the merge, they'll also transition to proof of stake, which should help out scaling a ton.
I hope my grandchildren see it.
Yeah, I know. Well, that it's a real thing that, I hope like that would be incredible, right? If we could if Ethereum scaling works out, proof of stake works perfectly, and then you have rollups and L2s kind of on top of it, you probably could have one chain that can handle everything we need, or at least close to it, some form of that. So, yeah, L2s right now, basically Ethereum main chain is extremely expensive to transact on, and a little bit slower than most people would like. So L2s are basically side chains that run in parallel. So you bridge your assets over to a side chain, do a bunch of transactions on that, and then you can bridge it back to the main chain. So say I knew that Cred and I were gonna have a ton of transactions between each other, and we're gonna be trading a bunch of stuff and sending each other, paying for each other's dinners and stuff like that. I don't need all of that recorded on the main chain, right? It's just Cred and I have our initial balances. We go into this side chain, do everything we need to do, that we don't need to necessarily be on Ethereum's main chain. So we have, 50 transactions between the two of us on the side chain, fine. and then we come back to Ethereum's main chain. So the only thing that the main chain has is our starting balances and our final balances, and kind of all of the other in between things that don't matter as much are on the L2.
That's pretty clear. Don, do you have any spicy stuff? You know, you always feel strongly about scaling and complain that crypto breaks and doesn't work as soon as it's gone up. Are you no pun intended, but are you optimistic about this layer 2?
I mean, it's at least a start, right? It's something that, because the history, basically, my history with scaling is I was closely tracking how blockchains were doing in 17, early 17, going into 18, right? And the more people used them, the less trustworthy. And I mean, in general, like, you had to pay so much fees that just wasn't worth it, right? And what I realized was that the space was very, very far from mass adoption, because I mean, no one could use it. The moment not even 1% of the world population started using it, and this is like a vast overestimation, everything broke. Bitcoin was unusable, ETH was unusable. Nowadays, it's a little bit different, as in, but we still have the same problem with ETH as the layer 1 kind of. It's not really something that normal people can use, because you still pay a lot of transaction fees, but there's at least something for people that actually know what they're doing to kind of avoid those. I don't really think it's very, very feasible for a blockchain beginner to bridge to other chains and do their business there, just because it's too complicated still. So that's my issue with it right now. But if that gets easier for the layperson, I mean, maybe we have a chance to kind of get more people into crypto. Right now, I'm not as optimistic as most, but there's at least a light at the end of the tunnel that I didn't see in 17.
It'll probably
18.
be done via apps that we don't even recognize it's going on. You know, once it gets done properly, I think that's what it'll look like. But the TLDR is basically the main chain, the layer 1, because it strives to, you know, prioritizes decentralization to a large extent. It's expensive to use and slower, etc. And layer 2s exist to, quote unquote, fix that. You know, lazily, I'm going to define that via innovation, so that you can have other transactions, perhaps less important ones, take place on the layer 2, which is built for higher throughput, more scaling, etc. And then they kind of go back to the layer 1 to be settled. Have I completely butchered that, or is that more or less kind of correct?
God, yeah, I think that's dead on.
Okay, and I should also mention for our audience that, like, we say layer 1, layer 2, but that layer 2 proposal obviously hasn't been accepted by everyone in the market, which is why we've seen the kind of Sol Luna AVAX, layer 1 trade, and Ethereum killers, Ethereum alternatives come about. And the implicit notion there is that, you know, there's no point, or it's in some way less attractive. Well, as in, you know, the layer 1 won't scale, the layer 2 bridge or transfer is in some way inferior, and therefore the way you actually achieve scaling is by doing it on the layer 1 and not on the layer 2. So that's kind of what, you know, what the market's been wrestling with for much of this year. The next one is fun. We've got a couple of acronyms, which are EVM and MEV. Where do you want to take those? I know they're quite different, obviously, but
yeah, definitely a little bit more on the technical side of crypto. So again, we'll try to just keep it high level, and that's kind of the point of this. But yeah, EVM stands for Ethereum Virtual Machine, and it's kind of the software platform that devs will use to create dApps on or decentralized applications on Ethereum. So basically, if something is EVM compatible, that means that you can use it from Ethereum or bridge directly to Ethereum. And it's part of the ETH ecosystem. MEV stands for miner extractable value. It's basically like a miner trick that has caught on a lot in the last year, or even a little bit more now. It's basically money that miners can make by reordering or inserting blocks. Usually it's used kind of in reference to ETH. Some of the other chains don't have the problem as much, just because their buying algorithm works differently. But basically, the thought process for MEV, or a classic example, is a sandwich attack. So people see a big trade coming in, because you can see the transaction before it's actually recorded on the blockchain. So people see that huge transaction. They say, a buy that big is going to increase price by 10%, say. So they go in, pay a bunch of gas to front run the trade. So they buy the asset before the big trade comes in. They ride that 10% up, and then they sell right after. So MEV is basically the max amount, of dollars that you can extract by kind of looking for trades like that. Would just be one example, but there's also other ways to do it as well.
See, Don, I told you it had nothing to do with fighting outside of Subway. You just didn't listen to me. Hopefully now that we've got some expertise, that much is obvious. Let's speed run to some extent. We're conscious of your time, of course. We're getting to the fun stuff. Obviously, you have to do the fundamentals first for it to make some sort of sense, having a frame of reference. But we've got this clumsily titled as blockchain use cases, which used to be a kind of oxymoron back in the day. Quite different now. You can speed through these as quickly or as slowly as you'd like. But we've got the first couple which are related. Is smart contracts, which is the bedrock for a lot of this, and then we jump into the specific derivatives of that, like Metamask and what's dApp, DeFi, etc. But in terms of setting the scene, a lot of this is even just working with ETH is interacting with smart contracts. So what is a smart contract?
Yeah. And I'll be conscious of the speed round here. I should be a little bit more fun to listen to too if you hit on a bunch of terms quickly. So smart contract, it's basically a program that's stored on blockchain, and it executes a given operation. So the classic example that anyone who kind of taught themselves blockchain by watching YouTube videos is a vending machine, right? That's an easy program. If I put in $2, I get to pick, what type of soda I want. A smart contract is basically that on blockchain that, it can allow you to basically use it in smart ways, and people stack them. Devs stack a lot of them now, make it very complex, but it basically allows you to be able to do, cool transactions and operations on the blockchain.
There you go. The way a lot of people interface with smart contracts, obviously not directly, but via, especially with NFT season and OpenSea going nuts, is Metamask. And apart from giving scammers seed phrases via extremely easy social engineering, what is Metamask used for? And, how does it work even?
Yeah. Metamask is basically a place where you store all of your wallets that started off pretty much just Ethereum, but now it's basically all EVM compatible chains, or most, I should say. It's basically the user interface for how people actually send money on Ethereum and interact with the chain.
And send seed phrases as well. That joke's never going to get old. It'll be like 2030. I'm still making jokes about Bored Ape Yacht Club. dApp, and we've got DeFi next to it. And I'm sure those are a little bit related. But once you actually start using these things for dApp and DeFi, people wondering on that side of crypto, what do these terms mean?
Yeah, dApp, decentralized application, pretty much apps or projects that you can use on the blockchain. DeFi, decentralized finance, basically banking in a decentralized way on the blockchain. For example, borrowing, lending, market making on chain. Pretty much the stuff that we use institutions and banks to do. DeFi is trying to do it in a permissionless way that we can all participate in.
Cool. I'm going to group these two together, even though they're not in the form they're in, is DEX plus AMM. Because again, with Uniswap and DeFi actually having use cases, aside from what we're used to, those two seem quite reasonable to clump together. And it's like a new way of trading, and it's very liquid. It's not some, crypto bridge edge use case. These things have a lot of depth, a lot of volume. So DEX plus AMM, what does that mean?
Yeah, DEX stands for decentralized exchange. So the classic pairing for that is CEX, CEX, centralized exchange. That's what more people are probably familiar with, Coinbase, FTX. That's a place where you can go to buy and sell different cryptos, right? So a decentralized exchange is basically an exchange programmed onto the blockchain that you can do the same, buy and sell different cryptos, trade, but there's no centralized entity that governs it. And the main innovation that kind of allows DEXs to work is an AMM, stands for Automated Market Maker. It's kind of hard to be brief on them, but basically the classical way to look at it is like a pooling of funds that people deposit into the AMM that allow you to actually, make markets and let people trade and have liquidity on demand. So they use, or most of them actually, we've seen some innovation here too for concentrated liquidity, but those are the exception to the rule. The rule would be that AMMs use an X times Y equal K algorithm on the back end. So basically, how much liquidity and how much slippage you'll have for a given trade based on how many funds are pooled into this AMM. So I take a step back, the high level, the AMM is kind of like the engine in the background that allows the DEX to run. And a DEX is a place where you can trade all of your cryptos back and forth. That doesn't require, hopefully doesn't require KYC or a centralized entity to kind of make the trades for you.
That's one of those coming in 2022 things. If we jump to DeFi Summer, back in the day, these two go together quite nicely. Governance token, still relevant, obviously, and yield farming. It seems like those two are synonymous in DeFi. What do they actually mean?
Yeah, governance token, basically a token that gives its holder the right to vote on protocol direction. Uniswap is kind of a famous example of this. Uniswap is a DEX on Ethereum, kind of, the first one made famous, kind of allowed DeFi to come about and thrive. But they needed a token to get people interested, invested in the protocol and its success. And basically the utility of the token is that you have governance, you have voting power in what the protocol will actually do in the future. And that's been adopted by a lot of cryptos now. So people will joke about a governance token kind of just being like, well, why do you need a token? That's an easy answer is, well, it's a governance token. We can let other people decide where the protocol goes. But yeah, governance token, basically a token for decentralized application, and its utility is to allow the holders of the token to vote on different aspects of the protocol. Yield farming, kind of the short and quick of it, it's lending and staking of your coins, and that lets kind of the people who are lending and staking get rewards from transaction fees or interest. So if you ever hear people referencing like high APYs or kind of risky farms, they're talking about yield farming, and they're talking about the percent gains that they're getting from the rewards for whatever they happen to be yield farming.
That was good. That's pretty clear. Look, we're going to take a swing at what I think are the big four. And I know people will think we should have done these at the beginning, but just like any other meal or experience, you have to build up to it and earn it and get the reward at the end, right? So the big four I'm thinking of for the benefit of our audience are NFTs, DAOs, Web3, and Metaverse. I could just crop this bit of the podcast of me saying those four words and probably raise like a 500 million fund like by tomorrow, the way things are at the moment. But if we try to take a sort of reasonable approach to those, we can do them in that order: NFT, DAO, Web3, Metaverse. NFTs especially, the amount of public attention they've garnered, primarily negative, and it's very topical and popular now to just like dunk on NFTs, even if you don't know what they are or how crypto works. The amount of hatred that I've seen for them come from the public sphere is pretty unprecedented, at least in my experience. So clearly there are some misunderstandings and some of the use cases that people associate with NFTs, which is the bored apes giving their seed phrases away. Perhaps that's only the surface layer of where we could end up. So I mean, for you, I mean, what does the acronym mean, obviously, but also what could it mean in terms of use cases?
Yeah, and I'll kind of run through those four in that order, like you said. And yes, I completely agree. If you just crop that 6 seconds from the podcast of you saying those terms and put that as the trailer, I'm sure it'll increase views by 5x.
Oh, for sure.
But yeah, NFT, it stands for non-fungible token. It's basically the underlying tech that backs virtual assets. So like it's kind of synonymous with crypto art right now, which again, I'm not saying that's its best use case. I'm just saying that's what people think of when they hear NFT. So it gets a lot of hate, and I can touch on that quickly. I think there are a few different reasons. One, people think all the minting of NFTs and creating them is absolutely ruining the environment. There's actually a hearing going on in about 30 minutes that is going to touch on the environmental impact of crypto and NFTs, but people hate it. They think it's destroying the environment, and that's from the outside. From the insiders, or people who are kind of crypto native, been in the space for a long time, they don't like NFTs because crypto is supposed to be this glorious tech innovation that's going to save us from totalitarian governments and all this stuff. And most of the things that is hitting the mainstream from crypto are pictures of, monkeys or whatever, cats, pick your favorite animal. And it's just people buying and selling them for absolutely ridiculous prices. I think as we go on, we're actually going to see a lot of innovation in the NFT space. I think right now we're in like the first inning of NFTs where people just realize that they exist and what you can do with them, and creating art and profile pictures, which is basically paying to be in a community and show off that you're in the community, are kind of the first use cases that make sense to everyone. I think gaming and the metaverse, which I'll touch on in a sec, are kind of going to be the next frontiers for NFTs, where you start to get utility NFTs and things that actually that will make a little bit more sense and put the crypto native people at ease a little bit more, I hope. But yeah, basically there's been an extreme craze around them. I think it's definitely net positive for crypto. A ton of more people hear about it now. They get interested in it. Like, that's how I would say 80% of my friends that are interested in crypto honestly got in because of NFTs. And then over half of them now have learned about DeFi and kind of gone to do on-chain transactions and stuff like that. So I think it brings a lot of people in. But that's kind of the overview for NFTs.
It's the gateway
and
drug to crypto.
Like now.
Yeah,
exactly.
I honestly think it's basically replaced the Doge of its time, right? So like we used to have Doge and that kind of stuff, and that was how people got in. Now it's profile pictures and like apes and whatever, which I think might actually be an upgrade, but I'm not entirely sure.
Yeah, well, Facebook announced, or actually, I don't know if it was an official announcement, but they're going to start integrating NFTs to Facebook and Instagram. So verified NFT holders, kind of like what Twitter's doing, but so that you can display your NFT and show it off there. But I mean, it's definitely made a wave. Everyone talks about it, and the hardest thing about crypto is getting people interested in talking about it. So if that's what gets them in the door, then great. But again, we said we were going to be super quick, and that was a super long-winded answer.
No, this is good. I mean, if anywhere we're going to spend time, if you've got stuff to say on these is probably, the big 4/5. So, as much depth as you'd like. And then, NFTs have become synonymous to some extent. And you mentioned one of the future potential use cases is in the metaverse. And that's probably where digital ownership probably finds its resting place, or kind of the most logical conclusion of where these NFTs may exist. And, Facebook rebranded to Meta and people kind of lost their minds. And analogies are made between the Metaverse and the Matrix, except in the Matrix, at least we fought and lost the war to the machines. Whereas in the Metaverse, you kind of voluntarily plug in Zuckerberg to the back of your head and there you go. I know there isn't like a strict definition, and maybe some of the best or clearest Metaverse use cases aren't even defined yet. But like, what does this term even, where do you start with this term?
Yeah. Meta, and just to hit on two NFT examples very quickly that'll lead into Metaverse, that I think we'll start to see there is like a decentralized identity that will happen that you'll need to kind of in the crypto Metaverse will likely be an NFT, and then like real world assets that the data will be stored on chain. So think of like real estate, like a house deed. A lot of paperwork, physical things that you need to store, but you need to make sure that they're safe. Something like that could be stored as an NFT and kept on chain. So there are utility use cases coming down the line that just are not as popular yet. That kind of leads into the Metaverse. Definitely been a hot topic of conversation, especially since Zuckerberg came out super in favor of it and changed Facebook's name to Meta. I kind of have, I've been studying it for a while now. I honestly got interested in it about a year ago from this guy, Matthew Ball, who writes about it a lot. So seeing the public kind of come in and fit it into their own buckets has been interesting. So my take on the Metaverse is kind of as it's like basically your online life, and it's going to become much more immersive in the coming future as your banking moves online with DeFi. The main thing Zuckerberg's targeting is your work moving online. So instead of having 6 monitors set up, you can put on your VR headset, and then you can, once you're in virtual reality, you can have 100 monitors if you want. You probably won't even use a monitor. You'll have holograms sitting in the air. You can basically play God mode with your workspace setup and teleport to meetings and stuff like that. So your banking is online, your work is online. Metaverse concerts would be, Travis Scott can have a concert where
maybe not Travis Scott, like.
Well, that's what I'm saying is Travis Scott can have a concert and it's guaranteed no one's going to get hurt because you're not actually there.
More people are going to survive the Metaverse concert than the real one.
Yeah, exactly. And so it's and then like when you hang out with your friends, say you want to hang out with your friend who's in California, before take a plane out, all that stuff. Now snap your fingers and you can go hang out in a virtual world. So it's kind of more of a spectrum. Like as all of these things become more mainstream and people have more significant portions of their life online, the Metaverse kind of emerges as your online life. Very likely has augmented reality and virtual reality tied into it. But it's also kind of a sliding spectrum. Like I would argue, like there's not going to be a point where we're like, oh, okay, the Metaverse is here, right? Like it kind of slowly emerges over time. I would say now we're at like maybe 10%. Like we're already in it, right? Like I'm sitting in front of 2 computer monitors and my laptop open. Like I have kind of digital feeds, like forums, Twitter, different ways to talk to people online. Like it's kind of like the beta version of the Metaverse. And then as these things get more and more immersive, it kind of emerges from there. So that's my take. That's what I think of. Like that's how I kind of see the Metaverse, quote unquote, playing out. I would say the public understanding of Metaverse is basically a VR land where you hang out with your friends. And it's not the Metaverse, like your online, like this encompassing thing. It's different metaverses. So I think most people think of it as like an open world video game pretty much. So like Call of Duty, you'll have all your stuff there and you can run around, or like SimCity would be a better example. You kind of just have like a life there. And then that's one metaverse. And then you have your workspace and that's another metaverse. I think they're using the word wrong there, but it also could be something where if enough people say it over time, that actually becomes a definition. So we'll wait and see on that.
I like
yeah,
that.
that's how that it's new, and we don't really understand it because it relies on a lot of tech that isn't even invented yet. How it kind of pertains to crypto, like I'm guessing anyone listening to this, if you sat through all the terms before, you're definitely somewhat interested in crypto. The reason that it's sparked so much interest in crypto, once Zuck announced that he's trying to do it, you kind of have two major scenarios playing out, where you either have a centralized metaverse, which would kind of be Facebook dominating the whole thing, or a decentralized metaverse, where everyone kind of establishes the truth for themselves, and there are oracles that can prove that something is true. Kind of the thing that people get scared of for Zuck's metaverse. So if you see a bunch of people tweeting about why it's so bad and all this stuff, is basically like, if you think about, what Facebook and Instagram have done so far, right? Like they basically only have your visual sense, and it's on this tiny little phone in front of you. And like it's already extremely polarizing, and they have so much power over society right now, and they have one sense of yours. If it goes from a little screen in front of you to your entire world, there is a lot more power in that, and you might see something. I think this is a very doomer way to look at it, but like how you mentioned, Cred, kind of the Matrix, where we all just plug in and say, "Okay, Zuck, here's my brain." That's what people are worried about. So if this tech is kind of inevitable, and we're going to move towards that, just because game theory and capitalism work together to create the metaverse, it's kind of much better for the individual if we create it with crypto and in a decentralized way than if it's top down from a centralized company like Facebook, or I guess Meta now.
Yeah, Meta. No, I think that's really, really coherent. And I also enjoy thinking about it in terms of people becoming digitally native from like a very young age and associate a lot of their positive experiences and their social circles and their network and the things they own are increasingly digital. So you'd expect that to spurn development and allow for some sort of more coherent and cohesive kind of way of existing online, beyond all this kind of fragmentation, which makes a lot of sense. Obviously, you'll get the dystopian capitalism attempt at it, and then we'll see where that ends up. But I think the basic premise, which is what you started with, especially, that a lot of the stuff we do is online, and that's going to change how we interface with those regular activities, and a place to maybe do it all. I think that's not too scary, right?
Mm-hmm. Yeah, no, I think
Cool.
that's 100%.
Yeah, well, I think we had a good swing at that. Definitely getting the fundraising round after that description. Web3 is another one, which is very broad term, and especially I think what unites Metaverse and Web3 specifically is you have people who are very much outside of crypto, for whom these are big talking points, and they suddenly become interested. Now, one of my favorite takes on Web3 is that we're again just going to onboard people into crypto and shitcoins, but just calling it something else. Now, the audience knows I love the super hyper cynical takes. Obviously, that's not the whole thing in its entirety, but if you had to add some flesh to Web3, how does it work?
Yeah. Again, Web3, super hot buzzword. Kind of fits into the funny quote. I do not think it means what you think it means. I would say Web3, like the short and sweet of it, it's the way people talk about it and look at it is it's a new decentralized internet where you actually own your online assets and you own your data instead of big tech companies. That's really what people think of when they think of Web3. So Web3 application, right, would be something that allows you to put your NFT online as your profile picture, have your online baking, play to earn video games, like stuff like that is all kind of plugged into Web3. But it's basically a decentralized internet that you own your assets, you own your data, and you hide that from big tech companies, and they kind of lose that power over you that gives people that eerie feeling. that they're playing in someone else's arena.
We seem quite far away from, sort of actionable either apps or ideas or implementations. Am I right? Because Metaverse, you can start to see some evidence of it. DeFi, especially, people do a lot of like banking, self-repaying loans, etc. If I had to just, eye test says that the Web3 is maybe the most ambitious, but also the more distant. Is that more or less how you see it at the moment, in terms of if there's a race of how close are we getting to completion of these things, or at least practical versions?
Yeah, I think that's spot on. And again, I don't think it's going to be something where it's like now Web3 is here and you switch your internet browser and it's Web3. I think it'll come across over time. I also think it's at this funny inflection point. It's just an analogy I thought of the other day that could help some people see it. It's kind of like when electric cars were being used in like the early 2000s. And people were like, the idea is probably there, but the tech was a lot harder to engineer with. And so people liked the idea, but the actual applications, the cars that you could buy and use, were pretty terrible. And we're kind of waiting for this Tesla moment, right? Where someone can come in and, they can use the clunky, like the harder tech and innovate on it and make it kind of this sexy, streamlined application where all the crypto is abstracted away, and it's like even better than kind of the Web2 apps we have right now. Yeah, that's kind of how I was thinking about it.
Yeah, it needs to be better, doesn't it?
It needs to be better. Absolutely.
Yeah, that's something we've been struggling with in crypto for so long, right? We all understand that it's a pretty neat way of doing things, but as long as it's worse than the counterparty, or like the opposite side, the decentralized side of things, it just doesn't really make much sense to use it, other than just betting on that Tesla moment, as you said. Something that's been in the media a lot for like bad reasons recently has been the DAOs. We've seen a massive crash on that front in the last week or two. What is a DAO and how does it work?
Yeah, a DAO, first off, DAO stands for Decentralized Autonomous Organization. Again, kind of the umbrella view, it's a group of people working together for a common goal. They sometimes have a token, but it's basically a way for people to organize. And it's similar to like almost a company. It's like if you merged a company and a community, then you get like a DAO. And they do different things, right? Like there's Pleaser DAO, where they kind of pool all their funds together and they went out and bought the Wu-Tang albums, so now they own that. There was Constitution DAO, so people, again, pooling their money together to try to buy the Constitution. And then there's DAOs with tokens, right? So like the curve wars, for example, going on right now in DeFi. Like it makes sense to buy up a lot of a given token because you get benefits from there. So a DAO will launch a token, have people invest in it, and then use that money to go and buy more of the token that you want. Again, I'm in a few DAOs, especially kind of from the CMS side, like from investing in projects that have gone and launched DAOs. I don't know if I'm hyper bullish on them, just because like it's one of those things that seems really good on paper, and then you get in there and you're like, maybe there is a reason companies are structured a certain way. Like 150 people all yelling at each other on Discord, it's kind of hard to organize. So I don't know. I think, really cool idea. And certain use cases, it can obviously be successful, but kind of experimenting and figuring out what those are will be important in the future.
Yeah, listen, Don, it's either an unregistered company / fundraising group entity, or it's a paid group of sorts. There you go. No, I'm sure this will age poorly. Exactly. And some awesome stuff will happen. And it's nice that it's penetrating the mainstream, usually for bad reasons. But hey, at least it's there. No such thing as bad publicity for crypto, right? The last one, which I know you're passionate about specifically, so I'd love to hear from you about this, is GameFi. Right? Now, again, I will offer, as I always do, the hyper-cynical asshole version, which is that GameFi is just, well, first of all, yield farming with extra steps, and second of all, I guess this is more of a question than a comment, really, but a lot of these games suck and they're really bad compared to, you know, the stuff we're used to and the current standard of gaming. So do we have to get around that for GameFi to do well? And also, yeah, just as a hark back to the first point, is it just glorified yield farming in its current form?
Yeah, really good question, and this is probably the area where I have the most specific knowledge.
Which is why we've kept it to the end, obviously, right, Don? The amazing hosts that we are. Sorry, go on. Take as much time as you like.
Yeah. So yeah, GameFi or play to earn gaming. It basically, in its purest form, is if you take video games and all of the rewards and achievements you get, basically you get to own those. So for like an easy example to understand, say you're playing Call of Duty and you reach level 34 or something and you unlock a new gun, but you don't really like the gun. You can actually take it because you own it now, go onto a marketplace and sell it to someone else who does like it for say like $50, right? So you're playing the game, you enjoy it. You get these achievements and unlocks and you actually own the assets and there's a marketplace for them. So as you get better, as you play the game more, you actually make money, oftentimes in the form of NFTs, sometimes in the form of the in-game currency. So it's this really cool idea of like all the video games that we've been playing, you basically are just buying into whatever the centralized entity is. So like for Fortnite, right? Like you buy skins from them. And that's kind of the end of the story. You pay $20 and now you get to look like John Wick. And that's all good. But I think if you get to own your own assets in game and go and sell them and actually you get more skin in the game, I think it makes it way more fun. I think it's going to bring video games to kind of a whole new level where you see even more adoption than we've seen so far. And there's a lot of really cool things you can do with it, right? Like when we were talking about GameFi internally a couple of weeks ago at CMS, and I was like, well, someone was kind of playing the cynic. I was like, well, imagine the entertainment value, right? If your favorite gamers, so say like TSM, is streaming in an online play to earn game, and it's a space battle, and there's $1 million of NFTs on the line, and they're going against the other top clan. Like people go nuts over kind of boxing fights where there are huge amounts of money on the line. Like if it's people can do it and stream it and watch it, like you get all your fans to engage and then they want to play and build up their community. Like you almost get the feeling of like getting in early to crypto where you have like that, I want to, you know, create wealth. And at the same time, it's super fun and all of your friends are doing it too. So that's kind of like the hyper bullish visionary look at it. They're obviously the cynical take, kind of what a lot of people have been kind of vocal about on crypto Twitter, is that basically the argument is we're not there yet. It's like the games that are out right now are really bad. And like you said, it's like yield farming, except you have to do extra steps and go manually do all this stuff, and it kind of sucks. Which is fair, right? I think kind of the beacon of hope that you can get at where we're actually at now versus where we could get in the future is I saw a stat actually that Axie Infinity, they were accounting for so Axie Infinity, for those who don't know, it's kind of like the 0 to 1 moment for play to earn gaming in crypto. They were kind of the first people to get mass adoption, or really the first people to do the play to earn model. And they got mass adoption in the Philippines. And we're putting up huge numbers. I think their market cap spiked to over like 30 billion or something like that. But one of the metrics was that like over 50% of active wallets, like daily active wallets, were being used on Axie Infinity. And again, someone please find the source. I don't want to go on record saying that and then It's not true, but I did read that over 50% of the active wallets were being used for Axie Infinity. And I think that's the metric that we don't take for granted in crypto, but we kind of underplay its value. Like you were saying earlier, Don, like the NFTs are like the gateway drug for crypto. I think if you mix NFTs and you have this play to earn gaming model, and then you get a game like Axie Infinity, again, if you go and play it, it kind of is like glorified yield farming. If you get games that are actually super fun, and you mix in the NFT play to earn component to it, like I think that's the next biggest onboarding step for all of crypto. And look at the user base, right? Like who plays video games? Generally, it's people who are age like 12 to 23-ish, is kind of like the biggest base of video game players. And it goes much younger and much older. But like those are also the next wave of people who likely adopt crypto. So again, I know we're trying to be a little bit shorter on some of these pieces, but I think getting to own your in-game assets for video games, building that into actual games that people like and enjoy and play, one, because the game component itself is fun, and then they're also incentivized to play it and can like earn a wage off of it, or at least just have fun with their friends. I think that's going to be like one of the biggest innovations, or kind of one of the biggest societal shifts that we'll see kind of in the next 5 years, assuming it actually works and takes off.
Just as the final point, if we had the 0 to 1 moment with Axie Infinity, if we think of a kind of 1 to 2 moment, or this idea coming to fruition and, taking grip, etc., do you think that's more like, in terms of order of operations, I suppose, is that more likely in your mind to happen via some AAA big game studio deciding to experiment with either NFTs or a non-closed loop economy and all of these concepts? Or does it come from a crypto native developer doing like a big raise, and then the game is actually so good that even the, incumbent gamers can't ignore it and buy into GameFi in that way? Because at the moment, like if you look at Ubisoft, tried to launch like a very completely basic NFT premise and they got blown up. And for gamers who are understandably, against any sort of what looks, even things that are remotely resembling financialization of their game, they're against it given the whole loot box, microtransaction culture, etc., that I'm sure people are aware of rather. So in terms of how these ideas hitting the forefront, do you think it starts with crypto and then hits mainstream, or does a mainstream company decide to take the plunge and then you got a proof of product at least that way? Where does it come from?
Yeah, I mean, I think whichever one, it definitely comes from one of those two paths, right?
Yeah.
And it's either going to play out in kind of the Blockbuster Netflix approach, where Blockbuster was like, we don't need this new innovative tech. You guys are going to fail and die on the vine. And then obviously everyone knows the story. Netflix ate their lunch and Blockbuster kind of got overturned. So that scenario would be one of the gaming companies that kind of raising money now, getting traction, innovate, grow, do really well, and kind of gain mass market share there. The other way it could play out is kind of the Facebook, Instagram dynamic. Probably less talked about because it's harder to see things that didn't actually happen. But basically, Instagram was getting so popular so quick and eating market share from Facebook. And Facebook was innovative, and they were like, no, we're actually, in this case, they bought Instagram for $1 billion. And then Facebook became so much bigger and more powerful from that. So that scenario would be, I guess literally it would be one of these gaming companies buying out a play to earn game. That's probably less likely. More likely would be, they realize they need to innovate. People like NFTs, and they introduce NFTs into their own game. So those are kind of the two scenarios that we're looking at now. My gut feel is that just because there's so much money to be made in NFTs and the way it grabs people's attention, I think bigger companies probably are more open to innovating now. So I think probably over the next 2 years or so, Hopefully, like it could be 1 year, maybe even less. It could take longer than that. But I think the games that are coming out now and, you know, putting out these huge fundraising rounds, a few of them do get very successful. And then they get large enough that they're too big to ignore. They're eating market share. Everyone's going on to those Twitch streams instead of League of Legends or Fortnite. And one of the gaming companies goes, all right, you know, enough is enough. And then they introduce NFTs onto their platform. So I think it's gonna, that's kind of bullish, right? Because then, you know, the companies we're at now, it means they pretty much have to like 50x at least in order to get to the point where bigger games actually will, or bigger companies feel like it's de-risked enough to adopt NFT gaming. I would guess that that's how it plays out. Right now, it's too new. Like crypto, most people don't understand it. There's kind of like a stigma around a lot of it. I would be surprised to see like Microsoft, who just acquired Activision, going and implementing NFT gaming right now. It's just kind of too unproven. But once it gets proven enough, and once a couple of the games get big enough, I would guess that they do implement NFT gaming and adopt it, and that's when you get like the super mass adoption, right? So that's
I
kind
look
of how I
forward to
thought
that
about it.
future. Kevin, thank you. This was awesome. Don, I know you learned something because I did, and let's face it, you're not that far ahead.
Wow.
Hope our audience enjoyed that. We'll leave the links to find and follow the much beloved CMS Intern in the links in the description. That's all from us. Gentlemen, thank you, and we'll see everyone else for the next episode. Bye-bye.
Awesome.